Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Decentralized finance, DeFi, is reshaping how people invest, offering new ways to grow wealth outside traditional systems. By using blockchain technology, DeFi protocols let users lend, borrow, and trade without intermediaries, opening doors to higher returns. But with opportunity comes risk, making it essential to understand how these protocols work before jumping in. Whether you're new to crypto or looking to expand your portfolio, knowing DeFi basics can help you make smarter investment choices. Understanding DeFi protocols and their investment potential. DeFi protocols are blockchain-based financial systems that replace traditional banks and brokers with open-source code. Unlike centralized institutions, they operate without middlemen, letting users interact directly through smart contracts. This setup cuts costs, speeds up transactions, and puts control back in the hands of users. But how do they work, and what makes them a unique investment opportunity? Key components of DeFi protocols. DeFi protocols rely on three core elements that define their functionality and investment potential. Smart contracts. Self-executing agreements that automate transactions. They eliminate the need for trust. Code enforces the rules. For example, Aave uses smart contracts to manage loans without a bank. Liquidity pools. Pools of tokens locked in a protocol to enable trading, lending, or borrowing. Investors who provide liquidity earn fees, but market volatility can affect returns. Uniswap relies on these pools to power its decentralized exchange. Governance tokens. Tokens that let users vote on protocol changes. Holding them can offer passive income through staking or influence over future upgrades. Each component creates opportunities, whether through yield generation, voting rights, or fee sharing. Types of DeFi investments. DeFi offers multiple ways to grow your capital, each with distinct risks and rewards. Providing liquidity. Deposit tokens into a protocol's liquidity pool to earn trading fees. High APYs can be enticing, but impermanent loss, a risk tied to price fluctuations, can cut into profits. Staking. Lock up tokens to secure a network or earn rewards. Some protocols, like Compound, distribute interest to stakers from borrower fees. Governance participation. Buy governance tokens to vote on proposals or delegate voting power. Protocols like MakerDAO reward participation, but token values can swing with market sentiment. Rewards can be substantial, but smart investors balance high-yield opportunities with risk management. Researching protocols like Aave or Uniswap can help you spot stable, long-term options. Evaluating DeFi protocols for investment. Not all DeFi protocols are equal. Some offer steady returns with lower risk, while others might promise high yields but collapse under scrutiny. Knowing how to evaluate them separates savvy investors from those who lose money to hype. Focus on security, tokenomics, and protocol health to make informed decisions. Assessing security and smart contract risks. A single vulnerability can wipe out millions. Take the 2016 DAO hack. An exploit in the code drained $60, forcing Ethereum to hard fork. Even today, smart contract risks remain a top concern. Here's how to check a protocol's safety. Audits. Look for protocols audited by firms like Certicate or OpenZeppelin. No audit. That's a red flag. Bug bounties. Platforms offering rewards for finding flaws show they take security seriously. Time-tested code. New protocols often reuse battle-tested code from established projects like Aave or Compound. If they don't, proceed with caution. Tools like DeFi Safety rate protocols on security practices. Cross-check audits and community feedback before investing. Analyzing tokenomics and governance. Tokenomics, How a token is distributed and used dictates its long-term value. Poor models lead to inflation or centralized control. For example, compounds comp rewards users for borrowing or lending, but heavy selling by early adopters can depress prices. Balancers BL incentivizes liquidity providers, but rapid emission can dilute value if demand doesn't match supply. Key questions to ask. Is supply capped or inflationary? Who holds most tokens? Large VC allocations can dump on retail investors. Can the community actually influence decisions, or is voting power centralized? Governance matters. Protocols with active, decentralized voting tend to adapt better than those controlled by a few wallets. Gauging protocol health. Beyond code and tokens, a protocol's strength lies in its adoption and team. Total value locked. Higher TVL often means stability, but watch for sudden drops. Team transparency. Anonymous devs. Risky. Known teams with public GitHub activity. More trustworthy. Community engagement. Check Discord or Telegram. Are users active, or is it all bots and hype? Look for protocols that balance innovation with reliability. The best investments aren't always the flashiest. They're the ones built to last. Risks and challenges in DeFi investments. DeFi offers exciting opportunities, but it's not without risks. Unlike traditional finance, there's no safety net, no FDIC insurance or customer support hotline. If something goes wrong, you're often on your own. Understanding these risks helps you stay ahead and protect your investments. Let's break down the biggest challenges and how to navigate them. Thanks for watching Part 1. There's more to learn, so stay tuned for Part 2, where we'll explore advanced tips and strategies. See you soon! Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.